Okay, now we will discuss another way to value a company. It's called the discounted cash flow model. As we've seen in the previous video, it is possible to conduct a simple yet efficient way of valuing what should be a fair market price for the shares of a company, by comparing it to its peers and by using ratios such as the earning per share ratio and the price to earnings ratio. Obviously, professional analysts and financial advisors will go more in detail. They will conduct a complete assessment of the operations of a company, and they will develop a model called the discounted cash flow models that will take into account revenues growth, forecast, operating expenses, in order to evaluate what will be the net income for the next 4, 5, 6 years. And they will calculate the value of the company based on the future profits that can be expected by the shareholders. So before we jump into this model, I'm going to review it quickly, because it's I propose to anybody who wants to learn more about this method of valuation to read about it. There's some good books that are available in the market, and it's obviously exceeds the scope of 15 minutes video. Before we jump into how the model is developed and how we can use it to calculate the value of a company, we need to understand a few things about economics. First, we need to understand that cash today does not have the same value as cash tomorrow. Value, not necessarily like $1 will be $1. $1 today will be $1 in 5 years, but $1 will not buy the same thing as $1 in 5 years. The buying power will change. Normally, the buying power of money will be reduced as we move in time because of inflation. We know that cost of life is increasing. Housing market, food, whatever you want to buy, normally it costs more today than yesterday, and is going to cost more in 5 years than it's costing today. So if we try to evaluate the company based on future profits, we need to take into account that profits that will be obtained 5 years from now will not have the same value as profits we can obtain today or tomorrow. So in the valuation model of the discounted cash flow model, we will take this into account, and this is why the word discount is used. What we'll do is we will try to evaluate the profits for the next 4, 5, 6 years, and we will discount the profits back to their present day value, so that we can evaluate the value of a company today. What we'll do, if you're familiar with the project economics, what we want to do here is to evaluate the net present value of the company, and once we obtain this number, this value, we will divide the net present value by the quantity of shares outstanding, and we will obtain an estimate of what should be the fair value of the shares trading at when the model is completed. So normally we complete a model, so we want to decide if we invest today or not. So we calculate the net present value of a company, then we divide it by the quantity of shares outstanding, and then we have an idea of what should be the fair price, and we can compare it to the market price, how much it's trading on the market, and we can assess if we're paying too much for a stock, or if we're paying a fair price, or maybe even if we're paying a discounted price. So The discounted cash flow model will take into account the time value of money, which is explained here. We will have to develop a discounted cash flow. So a cash flow is basically cash in, cash out. Whatever is left at the bottom of the cash flow will be a profit if it's positive, or a loss if it's negative. So for year 1, for year 2, for year 3, we need to develop a cash flow for each year, and then we will discount it back to present. This method can be used to value a project. I'm familiar with project valuation. The net present value model using discounted cash flow is widely used, and you can also use it to value a company you may want to purchase or you may want to invest in. So let's look at an example here. Let's say that we are trying to evaluate what is the value of, again, a fictional company named ABC Telecom. So before we do so, we need to forecast. For example, we're at year 0. We want to maybe invest in the company, but we don't know how much the company is worth. So we have to evaluate what will be the profits in 1 year from now, 2 years from now, 3 years from now, 4 and 5 years from now. Normally stop at 5 because obviously it's forecast. It's difficult to forecast 1, 2 or 3 years. Even 5, it's a long shot to be able to be accurate. So trying to forecast 10 years may be a waste of time. And let's try to be accurate in the first 5 years. That should do the trick. Then you also need to evaluate year 6. And I'll explain to you why. Year 6 will not be included in the model, but it's going to be used to evaluate the value of the company for perpetuity. So basically, obviously the company doesn't stop doing business after 5 years, but we don't want to estimate the growth of the company or the revenues for the next 20-25 years. So what we do is we estimate a cash flow for year 6, and it's going to be used to evaluate the value of the perpetuity of the company. So in that case, for example, to be able to build such a forecast, you need to use the past historical data, and you see how the revenues have been growing, how the profits have been growing, how the expenses have been growing. And then you try to evaluate if it's going to increase by 3, 4, 5, 10% for the next 5 years. So you put in the revenues, you evaluate the expenses you believe that will have to be paid by the company. You end up with the operating profit. Then you remove if there's any expenses from sustaining capital. Then you end up with the cash flow before tax. Obviously, what we want to evaluate is the value of the company after tax. So once you have the cash flow before tax, you try to calculate the taxes. For example, you want to invest in a company that's paying 3% tax. So yeah, try to evaluate how much tax is going to be paying by using some depreciation. And then you end up, for example, in our case, year 1 after tax, $16.2 million. Year 2, $17.24 million. Year 3, 17.03, 16.96, 15.98, 17.8. This is the profits, so positive, so the company will make a profit in year 1 to 5, and we expect that year 6 is going to make a profit of 17.8. Then what we need to do is to calculate the discounted cash flow. So we have to use, say, what's the value of this 16.19% that's going to be obtained 1 year from now, but what's its present value? What is the present value of year number 2, the profit, year number 3, number 4, number 5? So you use this calculation here. So the cash flow, which is in that case here, divided by 1 plus the discount rate, which we'll discuss shortly, and the n is the year. So in that case, 16.2 divided by 1 plus, here I've put 9%. I'm going to explain why. It could be 7, could be 10, depends on the type of company, depending on your investing philosophy. But I've put 9, so it's basically 16.9.2 divided by 1.09, that's 0.09 or 9%. And for year 1, n is 1. So then I end up with 14.9. Same thing with year number 2, 17.24 divided by 1 plus, again, we use the same discount rate all across the board. So in our case, it's 9%. And in that case, n is 2. So I end up with 14.5. 3, well, CF cash flow is 17.03 divided by 1.09. N is 3. 13.2 million. Same thing goes for 4 and 5, and then you have the discounted cash flow for each year. Then for perpetuity, you're going to use the cash flow that you have estimated for year 6, and then you divide it by the discount rate you've used. In our case, it's 9%, minus the growth rate that you expect that the company will grow for perpetuity. That's, again, it's a forecast. You try your best. In that case, I've used 3%, so 9% minus 3%, I end up with 6%. So I've calculated the value of the perpetuity to $296 million, and then I had to bring this back to its net present value. So again, I'm using that formula. Cash flow is 296.6 divided by 1 plus 9%, and n in that case it's 6, because I've used the 6th year to calculate it. Once I have this, for each year I have the discount cash flow. The enterprise present value will be the sum of these. So net present value of the company will be the sum of the cash flow, discounted cash flows. So I end up with 241.8 million. The weighted average cost of capital is normally used for the discounted rate, the discount rate. It exceeds the purpose of this video, so I propose that you read on it. It's not that complicated, but you need to take time to understand how it's calculated. Or you may want to put in your own discount rate. For example, you want to use 10% because that's what you expect from your investment. So put 10% or 7%, and you will end up with what you believe is the enterprise value. Once you have this number, that's the total value of the company. If you want to know what should be the fair price of a share or the stock price, then you have to divide this value here by the quantity of shares trading publicly. And you will end up with the value that you can compare to the current market price. And you can validate if you're paying too much, or if you're paying a fair price, or if you are making a good deal by paying a discount. So it's time consuming to prepare the forecast, but it can be a solid evaluation once you're done, and once you've done a few ones, you can feel more comfortable about using this method more frequently. But you can back it up with your by using the valuation model using ratios only. So basically, the evaluation of a company is the sum of the discounted free cash flow. So the cash flows, each cash flows is brought back to its current year, to current value, present value, by dividing it by 1 plus a discount rate. N is the year for which the cash flow has been calculated. You have to add back the perpetuity, sorry about that, which is the cash flow for your year at hypothetical year 6, that you divide by the discount rate minus the growth rate you expect. And the enterprise value is the sum of the 4 or 5 discounted cash flows plus the discounted perpetuity value. Again, discount rate should be the weighted average cost of capital. I propose that you read on it to understand a little bit more how it's calculated. But for people that are used to value projects, you know that you can maybe also use discount rates that fits your investment strategy. So if you want to invest by using 10% or 8% to be able to include a little bit of risk and to protect your investment, then that could be done too. It's up to your investing philosophy.